Hi, I'm Suzy Rhoades with PassMasters. Welcome to this week's Questions of the Week. This week, our topic is Pooled Investments 1. You can expect this topic to appear on the SIE exam, Series 6, Series 7, and Series 65. We will be taking a 10-question topic quiz from within one of our PassMasters Securities courses. Let's check out our learning management system. An ETF trades most like choices include open-end funds, municipal bonds, common stocks, or corporate bonds. An ETF stands for an exchange-traded fund. So it's a type of pooled investment similar to an open-end mutual fund, but an exchange-traded fund trades in the market, in the secondary market, on an exchange. It trades most like common stocks. So within our learning management system, you will select what you believe is the correct answer. Click Check Answer, and you will see the green check mark that you got it right. You have the option to click Show Explanation, and you will see a written out explanation. All of our questions also will include an audio explanation. An ETF trades most like it's me. So we do that so that if you learn by listening, you have that option. So that is available on all of our questions within our securities courses. A real estate investment trust, commonly called a REIT, must pass through at least blank percentage of their taxable income in order to avoid double taxation. This is what's called the Conduit theory, Internal Revenue Code, subchapter M. It applies to pooled investments. The requirement is that they must distribute at least 90%. But what is this talking about? I have to write some things down for you. So with this question in our portfolio, we have real estate because it's a REIT, but this would be true of an open-end mutual fund as well. So the question is, how much of the income earned by the portfolio must be distributed to the REIT shareholders in order for the fund to avoid double taxation? So you look at the portfolio or the fund's gross investment income. The fund itself is going to have operating expenses. The fund is left with net investment income. The fund, the pooled investment, the portfolio's net investment income. So the question is, how much of these dollars need to be distributed down the pipeline through the conduit to the shareholders in order for the fund to avoid owing taxes on their net investment income? So the requirement is this 90%. So if the fund does distribute, or the REIT does distribute 90%, the 10% that they kept would be taxable to the fund. If they distribute 100%, which many of them do, then they have no taxable income at the net investment income level of the fund. If, however, they distribute, let's say, 75% of their net investment income, do they meet the conduit theory? No. So sometimes you'll hear a regulated investment company or a regulated REIT. Regulated in this sense means that it follows Internal Revenue Code subchapter M, this conduit theory. So if it doesn't meet the 90%, in that example it distributed, let's say, only 75%, What ends up happening to the fund is 100% of their net investment income is taxable to that pooled investment, be it a fund or a REIT. So regulated under the Internal Revenue Code, subchapter M, the conduit theory. The question talks about avoiding double taxation. So the distribution of the dividend to the shareholder, dividends are always taxable to the shareholder. So that if the fund distributes 100%, then none of this was taxable. If they distributed the 90%, then only the 10% was taxable. If they distributed less than 90, then 100% of their net investment income is taxable, as well as whatever dividends they distribute are taxable to the shareholders. So that's the double taxation that is referenced in this question. Under the Investment Company Act of 1940, all are types of investment companies except. Always reword the except question. Literally write it on your scratch paper. There's something about being able to read it and then read the question, obviously, go back to your answers, but it just helps if you take out that negative. So, which is not a type of investment company? You have to know there's three. Anytime there's three of anything, the test loves these types of except questions. Choices are open-end mutual fund, unit investment trust, management company, and face amount certificate company. So those last three, those are the three types of investment companies under the Investment Company Act of 1940. It is open-end mutual funds fall under the category of management companies. All mutual funds are management companies. An open-end mutual fund is not a type of investment company. So that is the correct answer. Which type of REIT owns properties? Choices include property REIT, loan REIT, equity REIT, or mortgage REIT. There is no such thing as a property or loan REIT. Those are made up. They sound good, but they're pretend. An equity REIT owns properties. It depends upon rental income to be profitable. A mortgage REIT would have mortgages in its portfolio. There is also a hybrid REIT that has a little bit of both, mortgages and properties. All are true of closed-end funds except rewording it, what is false about closed-end funds. An investor can buy full and fractional shares. I don't think so, but we're going to read them all before we pick. The fund may issue common stock, preferred stock, and debt securities. The price for the share is determined by supply and demand. Yes, closed-end funds trade in the secondary market. The shares sell in an IPO only once. That is true. So when you have an open-end mutual fund, you can buy full and fractional shares. Closed-end funds trade in the secondary market. When a share trades in the secondary market, you can only buy a full share, not a fractional share. The fund may issue common stock, preferred stock, and debt securities. That is true about a closed-end fund. If it had been an open-end fund, that would have been a false statement. So the right answer for this question is the false statement. That can feel really weird on the test, but just practice that, picking something that is wrong when the question is asking for that. Which of the following is correct regarding a unit investment trust? They are actively traded in the secondary market. The portfolio is actively managed. False. They are designed to be held short term. False. They issue redeemable securities. That is the only one of those that is a true statement. Unit Investment Trust. They're a type of investment company. They issue redeemable securities. They do not actively trade in the secondary market. That is a false statement. Which of the following would have real estate in its portfolio? ETF, REITs, open-end funds, or closed-end funds? It is the REIT. It's a real estate investment trust. It's either going to have properties, which is the equity REIT, mortgages, which is the mortgage REIT, or be a little bit of both, which is a hybrid REIT. Which type of management company is a continuous primary offering of new shares? Choices include exchange traded, open-end, UIT, or closed-end. It is the open-end mutual fund. You can sell it with your SIE and Series 6 license that is a continuous primary offering of new shares. If you don't want your shares anymore, they are not sold in the secondary market. No, they are redeemed by the transfer agent of the fund. So continuous primary offering, open-end. A closed-end fund has an IPO only once. Exchange-traded funds are registered under the Investment Company Act of 1940 as. Choices include a unit investment trust, a management company, a face amount certificate company, or either a management company or as a unit investment trust. It is that last one there that is the correct answer. Exchange-traded funds are registered either as a management company or a UIT. Which of the following offers a continuous primary offering of shares? So it's a similar question to one that we already had, but that's how the test is. UIT, closed-end fund, open-end fund, or ETF. It is the open-end fund that is the continuous primary offering of shares. So nobody will ever own your shares of an open-end mutual fund. You redeem them. The transfer agent, I like to think of it that they just rip it up, throw it away. And if somebody wants to buy a share, they issue new shares. That's it for this week's questions of the week. Pooled Investments 1. I hope you learned something. If so, be sure to give this video a thumbs up. Subscribe to our channel if you're new here and turn your notifications on. If you'd like to check out our PassMasters Securities course offerings or to enroll in any of our programs, there is a link found in this video's description. Thank you so much for watching. Happy studies! I hope to have you as a student soon. You got this.